type of investing should I be involved in, or what are the types of investing in the stock market? Well, there's many types, okay? Today we're going to talk primarily at a very high level about two types of investing in the stock market, and that is where we buy stocks or good quality ETFs, exchange traded funds, and we do so with a mindset of either growth or income. Again, the mindset is either going to be growth or income, or it can be blended to where it's growth and income, somewhere, more along the lines of being in the middle there. But what is growth versus income investing? Okay, well, growth investing, or some people may refer to it even as trading, is simply, my goal is to buy at a certain price, let's say $10, and ultimately have that grow either a certain amount, maybe up to $100 per share, or a certain percent. Maybe that's, 25%, 50%, 100% or more. And at that time, I'm either going to just continue to let it grow, or I'm going to sell some of it or all of it and reallocate into something else. Okay, take my profit, and that is a strategy, and there's nothing wrong with that strategy. However, that strategy, one of the things to consider is that, actually there's several things to consider, but one of the primary things is that when you buy, let's say at $10 and it goes to $100, and you sell it, now you have a $90 gain, or what's referred to as a capital gain. That could be a short-term gain or long-term gain. However, it is a gain. You received $90. That's $90 cash back into your account. And one of the things that you now have to do is pay income tax on that $90. Now, if we say that that $10 to start with was $1,000 and it went from $1,000 to $10,000, now you have a taxable event on $9,000. So whatever your tax bracket is that you fall into, you could be paying, $2,500, $3,000, who knows what it may be, but that's something to consider. Now, if that investment is in an IRA account, okay, a tax deferred IRA account, then yeah, you're not going to have to pay income on that gain. Okay, later on, when you begin to pull out, let's say it's a traditional IRA and you begin to pull out money, okay, yeah, you're going to have to pay tax on, your distributions, but that's down the road, and the theory is that you'll be at a lower tax bracket. I don't always find that that's true, but that's one of the things that people consider. So when you're talking about growth, those are the things to think about. Not a bad strategy, a good strategy if you're looking to see numbers pop from, 1,000, 10,000, 100,000, a million and beyond. You look at that, but I want you to understand that just because it goes from 100,000 to a million does not mean you actually have that money. You don't actually have the money, okay, the currency, the fiat. You don't have that until you liquidate, and now you have the cash, okay? Because you can't spend stocks. Okay, you have to liquidate the stock, the asset, convert it into something that we use called cash, currency, to go out and buy things, pay your mortgage, whatever you may want to do. Okay, so that's, again, there's a lot to talk about there, but I'm just giving you something real, high level here. Okay, the second type of investment that I want to talk about, or investing, is income investing. Okay, income investing is where, once again, you buy stocks or ETFs, exchange traded funds, and you buy them, but your primary purpose in buying them is to get yield, or to get a percentage back to you on a consistent basis. Usually that's quarterly, okay? And you can buy, like I said, stocks, companies, okay? Like IBM or, Apple Computer, whatever it may be, or you can buy exchange traded funds like SCHD and some of these other funds that exist out there. And again, you're looking at yield. It's kind of like putting your money in the bank, and the bank's, of course, going to give you very little interest on your cash. But if you buy stocks or exchange traded funds, the yield's going to be higher because there's market risk, because the price can of course change. So let's look at that for a moment. That's an area that I really like. I like income investing. I like to have quarterly or monthly income coming in. I'm not so concerned about what the stock market's doing up or down. Okay. When you talk about income investing, let's break it down into three separate categories. There's, you're looking at low yield, high growth type stocks. So for example, Visa is a company that has consistently grown on an annual basis. It typically goes up in price, or it has been, but it pays a very low yield. It pays 0.80% yield on to shareholders. Okay. Some people say, well, okay, that's a little bit of gravy, but I'm really more after the growth. Okay. We go back to growth, but you're getting a little bit of dividend. That's good. There's nothing wrong with that. Then you have another category, which would be average yield and average growth. So you're looking at stocks and ETFs that have an average yield and average growth. So what is that? Well, that would be a company like Procter & Gamble. Okay, ticker's PG. Good company. I've owned that company. You're going to get an average yield of about 2.3%. Okay. And you're going to have some growth. Okay. It's not going to be astronomical growth. It's going to be a shoot to the moon type stock. But you are going to get some growth there typically. Okay. Now, again, markets go up, markets go down. Things can go up and down. That's just the nature of the game. The other thing is high yield, low growth stocks in ETFs. So a high yield or a higher yield and a lower growth stock would be something like Verizon that pays a rate of 6.3%. Okay, but it doesn't move up that much. Okay, I owned Verizon in the past as well. It's kind of more of a flat, slightly up, slightly down, but it stays within a range. But it pays that 6.3%, better than the bank. Okay, interest rate or dividend. Okay, so those are three areas to look at. Those are generally done with stocks. Okay, you can do it with ETFs as well. Some of those ETFs, one of the big ones out there that a lot of people like is SCHD. That's the Charles Schwab ETF. And that pays a dividend of 3.53%. Okay. An annual yield of 3.53%. Now, here's the thing to consider with that. Okay. And it does grow. It does grow. Again, it's not a shoot to the moon one, but it does generally tick upward. Okay. So a lot of people like that. Here's something to consider. Okay. So when you look at SCHD, the Charles Schwab ETF, that's trading, I looked at it today, it's around $80 per share, roughly 79 something, but we'll just call it $80. Okay. And let's say you have $8,000 you want to go out and buy, and you buy 100 shares of SCHD at a price of 80. That's $8,000. You're going to have market or price exposure. Can go up, can go down, but you were, thinking or hoping that it goes, or planning that it goes up. But if you take that yield of 3.53% and you apply it to the money that you invested, then what SCHD is going to pay you is they're going to pay you 82 cents for every share of stock you have. Okay, 82 cents. So that's going to be $82 that you're going to get per quarter. There's 4 quarters to a year, so you're going to receive income from the Charles Schwab ETF of $328 per year. So you invested $8,000, the price could go up or down, but you're going to get somewhat consistently, perhaps even it's going to go up in rate slightly, you're going to get $328. So that's a type of income investing. You like that. I mean, that's good because now you have an investment. You're getting a rate, it's decent. You have growth, potentially growth, movement, where you increase in total market value. You take that $328 per year. Perhaps you buy something with it, or generally like to see people put that money back into the market and use it. It's quote free money, as it were. You take it and you go and buy some more stock or ETF and so on. Okay. So that's a good strategy. That's a good play. If you start young, you start in your 20s or 30s, whatever. Yeah, by the time you're 60, 65, you consistently do it. You get compound. You compound it. You're gonna do. You're gonna do well. Okay, we can back test all this stuff, and it seems like that would be real well. Then you could look at another ETF, another fund, which is what we call the high yielders. Okay, this is something like SVOL. That's the simplified volatility fund, okay, which has a covered call. I believe they have a covered call feature on that. Okay, that's going to pay 16% versus, in the case of SCHD, 3.5%, we'll call it. Okay, and that trades at $22. So you can take $2,200 and buy 100 shares, whereas the SCHD you had to take $8,000 to buy 100 shares. And if you took that $2,200, bought the 100 shares, you now own those 100 shares of stock. It is going to pay you an annualized interest rate of 6%, or a dividend rate, a distribution rate it's referred to, at 16%. The thing about this particular ETF, it pays monthly. So that equates to a 30 cents per share monthly distribution to shareholders. So in the case of 100 shares, take 100 times 30 cents. What is that? That's $30. If you multiply that by 12, that's $360 per year. Okay, now the SCHD was $328 per year. This one is $330 per year. However, you only invested $2,200 versus the $8,000. If you wanted to take the same amount of money, $8,000, slightly less, you could buy 360 shares at a price of $22, and that's going to cost you roughly $8,000. Again, slightly less. If you take those 360 shares and you multiply it by, the rate, the distribution rate, which can change, by the way, it can go up or down, but this one's pretty stable in its history. 30 cents, 360 times 30, okay, that's going to be $108 per month, or $1,296 per year. So what am I saying? There's ways for you to create a paycheck for yourself on a monthly basis if you know what you're doing and you get the education, the awareness, the information about what's available out there. Now remember, in investing, there's always risk. Some is higher risk, some is lower risk. You have to understand what your risk tolerance is. But there are ways, again, where you can take money, invest it, and each and every month you get paid. And that's one of the things that we teach people. I would say that if you're interested in hearing more about this, we help people in finances, from budgeting to understanding business to understanding stock market, different types of return strategies and things like that. You can get our financial coaching, and to get that, you can go to icanadvance.com. That's our website. Okay, icanadvance.com. We have a lot of different coaching lanes. Look for the financial plan. That financial plan is going to give you 5 weeks of personal coaching with me. And I'm going to look at your situation. We're going to talk about some things, kind of see where you're at and give you some options. Okay. And then you make a decision, and then we go from there. If you want to do that, okay, again, go to icanadvance.com. If you're interested, if you're serious, not everybody's serious. Some people like information. They just kind of they watch a video like this, like, okay, cool. But if you're serious, and I know, and you should be, get that coaching. Let me know if you're serious, and I will send you a code, and I will give you 10% off the price of that plan. It's already packaged at a very, very low price because I want people to become educated in the markets. I'm here to help. Okay, I'm here to show you things that you probably don't know. Okay, many of you do, but a lot of you don't as well. So go ahead and do that. If you have any questions, you can put them down in the comments below, or go to the website and you can see our toll-free number. Go ahead and give us a call. Be more than happy to talk to you. But sign up for that coaching. God bless you guys. Remember to walk in increase, in dominion. I'll see you next time around. Bye-bye.